For Stacking Up, we are joined by Scott Bauer. He's with Trading Advantage here with our final trade of the day. And happy to have you on as always, Scott.
Always a pleasure being
here.
Now,
you're taking a look at Caterpillar. Why is that?
Well, yesterday was really interesting. Stock was up pretty big early in the morning, and then later in the morning yesterday, the company came out and actually said that the analyst expectations for 2017 were too high. The guidance was too high. The stock halted for a little while. Stock reopened down from where it was, but then rallied back and really, had the same momentum as it has over the last few weeks with the Trump rally. So to me, I look at a stock like this and say, okay, they just had lowered guidance in October. The company just came out yesterday, said your expectations are too high. Maybe the stock got ahead of itself. And, maybe with this Trump rally, it got ahead of itself. So I'm looking for any opportunity there, on the up or downside. And what I found is, to buy some January put spreads out towards regular January expiration was very inexpensive. In fact, with the stock trading around 95, 96, you could buy the 90.85 put spread for about 75 cents. Now, the expected move that the option market is pricing in Caterpillar out to regular January expiration is about $7. So if that happens to the downside, that puts me under the 90 strike. So to me, that was a reward to risk opportunity I really wanted to take advantage of, and I think you have to watch for that. Company says that you're being too optimistic. That's definitely something to watch out for.
You know what I think is important to watch in this market? A lot of stocks have run up so quickly.
Unreal.
And I think it's the smart traders and people who are really paying attention to this market who are going to win, because there have been some knee-jerk reactions in some of these stocks. Some may hold, some may be up for a good reason, but others might not.
This sector rebalancing that we've gone through over the last week, 2 weeks or so, I have never seen anything like this in my 25 years of professional trading. Something that happened so quickly and so definitively, with getting out of the NASDAQ stocks, the FANGs, and into the banks and the energy, that the proverbial slogan of you don't want to catch a falling knife definitely applies here, but this happened so quickly, and like you said, so many knee-jerk reactions to some of what we've seen here, that there definitely has to be some opportunity.
Do you think the NASDAQ, those big tech names such as Facebook, have been just hit too hard at this point, or do you think there's still some more downside?
I do think there's a little more downside. The one thing that gives me some concern, especially in Facebook and Google, is that we've breached the 200-day moving averages to the downside here. Those, especially Facebook, was pretty big support, and that gives me a little cause for concern. I am looking to dip my toes in if these stocks come down a little bit more, because again, I think we've had too much of a knee-jerk reaction, but not just yet.
Thank you so much for your Trader Talk
pleasure
today.